Hello, good afternoon. You've tuned into Mutual Fund Corner on CNBC TV18 and I'm Vinnii Motiwala. Let's talk about something very interesting that has happened over the last week. Now, the Sebi has released a framework for the new category of investment products that is called the Specialised Investment Fund. According to the Sebi, the category aims to bridge the gap between mutual funds and portfolio management services. Now, this new framework is set to come into effect from 1st of April. But what does it mean for you as investors? Who should be actually going for this option as well? And which one should you be choosing? There are categories coming in. To discuss more on this as well, we are joined by Kirtan Shah, founder of Credence Wealth, joining in with us. Kirtan, good afternoon. Thank you so much for joining in with us, as always, on CNBC TV18. Kirtan, let's start just by the basics first. What is SIF or Specialized Investment Fund?
Vinnii, thank you so much for having me on the show. So a couple of things. I think you should actually look at SIF as a traditional mutual fund only, which is allowed to do 25% derivatives. So in a traditional mutual fund, what typically happens is you are allowed to do derivatives, but that's typically used to hedge your investments. But in SIFs, you are actually allowed to take 25% unhedged derivative positions. Now, this typically may help the SIF to, kind of leverage or even make monies by shorting stocks or sectors or indices. So if you look at it in that sense, let's say, to give you an example, in a traditional mutual fund, let's say there is a flexi cap mutual fund, right? Then in an SIF, the same flexi cap mutual fund, when is allowed to do 25% derivatives unhedged, then you will call that strategy to be equity long short SIF, right? So like you rightly said, it's actually a product between PMSs and mutual funds. And I'm assuming that Sebi typically, kind of gave an okay for such a product because a lot of retailers were kind of delving into F&O, and this product probably may be a substitute if at all they want to do derivative investing, and they can use this route. So look at SIFs as traditional mutual funds plus 25% derivative options, but the minimum ticket size here is 10 lakhs of investment.
Okay, so minimum ticket size is 10 lakh. The difference is that there is a 25% derivative option in this one. So fund managers will be able to do F&O trading in this one as well, in this sort of a mutual fund, that is the SIF funds, right?
Yeah, absolutely.
And how is it different from PMS then? What is the difference between SIF and PMS?
See, there are a lot of differences between SIF and PMS also. Like say, for example, SIF is 10 lakhs, PMS minimum ticket size is 50 lakhs. Typically, even in a PMS, while some bit of derivative is allowed, it's typically not the unhedged part like in the SIFs. And the main difference, in my opinion, is going to be on the taxation front, Vinnii, because in SIF, it is expected that in spite of the derivative play and whatever we've discussed, the tax part is still going to be capital gains, like exactly in the way in MFs, where when the fund is buying and selling within the fund, right, you are not expected to pay a separate capital gains tax. Unlike in a PMS, where every time buying and selling happens, you are expected to pay a tax. So I think that's a very large difference between the SIF and the PMS.
And Kirtan, what are the strategies that SIF can offer right now?
There are 7 strategies that are currently allowed. There are 3 in equity, 2 in debt, and 2 in the hybrid category. If I have to break that down, if you look at the equity category, Vinnii, right, the first fund is something called as equity long short. Now, like I said in the last answer, it's actually the traditional flexi cap fund with 25% derivatives, right? Now, the second one is something called as equity X top 100 long short. This fund has to be looked at as a mid cap, small cap kind of a fund, where 65% of the money has to be invested in the X top 100, which I'm assuming is going to be mid and small. And the third is sector rotation long short, in which you have to look at it as a sector fund. 80% of your money has to get invested in 4 sectors. Now, in all of these 3 categories, you probably might see daily redemptions like currently is happening on the MF side. But on the fixed income side, on the debt side and the hybrid side, there are some interesting developments. So if you look at fixed income, on fixed income, there are 2 SIFs. The first is called the debt long short. Now look at this as a dynamic bond fund where the fund is allowed to invest across duration but they are allowed to take some derivative position. And sectorial debt long short. This is a new category where minimum two sectors are in which most of the investments will happen, but one sector cannot have more than 75% weight. So you will have more than two sectors, but minimum there needs to be two sectors. Now the change here is that in the debt category, Vinnii, it is possible that the redemption is allowed only once a week kind. Right, and in hybrid also there are two opportunities. The first is called the active asset allocator fund. Look at this as a multi-asset fund on the traditional MF side, and then there is something called as hybrid long short. Now again, look at this as a balance advantage fund on the traditional side, which is allowed to do derivatives, right? So again, in the hybrid category, redemptions probably maybe twice a week types. So again, like I said, it's actually a combination of traditional fund where some layer of derivative is allowed.
Okay. All of them have that mix of traditional fund with the derivative funds, obviously in different categories, debt or hybrid. They have their own uniqueness as well, but a mix of all of that combined. Kirtan, you mentioned 10 lakh rupees is the minimum investment in this one, right? So then how does it work? Is it going to be always lump sum, or is there SIP route as well? And how does that 10 lakh come into this picture then?
So Vinnii, whatever we've learnt and heard so far, the minimum investment is 10 lakh per PAN, which means if there are 7 categories, you can divide this 10 lakh rupees amongst either one or all the 7. But in total, on one PAN, you will have to invest a minimum of 10 lakhs to start with. Now, let's say if you invested 10 lakh rupees and then the market goes down, right, and it becomes 9 lakh, then it's okay because you initially invested 10 lakhs and then it fell. Right, but you cannot, when the NAV has gone down from 10 lakhs to 9 lakhs, then you cannot say that I want to do 1 lakh of redemption, right? Then if you want to do redemption, you will have to do the entire 9 lakhs. So if once you invested 10 lakhs and the market takes the value down, it's okay, but you cannot redeem and bring the value down below 10 lakhs. That's one. And second, once you are able to maintain the 10 lakh of threshold, Vinnii, you are allowed to do an SIP, an SWP or an SW or an STP over and above the minimum threshold of 10 lakhs.
Okay, so I have to first, the 10 lakh investment is necessary, whether it's across those different categories what you do, but on that PAN, one PAN has to have 10. So I'm investing 10 lakh rupees. Over and above that, then I can start a monthly one of 1,000 rupees SIP. That is also okay as well.
Yeah, once you are able to maintain the 10 lakhs of minimum requirement, then you can do most of these layerings.
Okay, so that is just the layering on top of it is what you're highlighting. It's not the first one. You have to have that 10 lakh investment. Typically, who should opt for this now? Who does it make sense to, put in? Because it's some sort of a way, it is lump sum, and then you can go on with, an SIP route or other methods as well and layering it up. So who should opt for this? And are there typical financial goals that one should have? Who's looking for it, like maybe a retirement or a child education? Who does it make sense for then?
I think, Vinnii, for me, very honestly, I don't think this is meant for retail investors. Because look, the way I really look at investing from a retail standpoint, I am also of an opinion that even sector funds are not really meant for retail, right? So in that context, this is way too far. So I'm of an opinion that this is actually not meant for retail. This is more of a sophisticated product meant for HNIs who've kind of got 50 lakhs or a crore kind of investments, and then they are looking at doing a 10% or a 20% of their investments in this on the tactical or the satellite side of the portfolio, then it is okay. But I don't really think just because it's a new product, retail investors who are trying to build their investments using SIP, they have a very small portfolio, or they don't really understand investments as well like any other sophisticated investor would, should actually jump onto this just because this looks something fresh, something new. This is actually not meant for retail, at least in my opinion. I would rather only look at probably HNIs or sophisticated investors wanting to do this product.
Okay, not too friendly for retail investors. Not many may look for it. HNI, for them, it's a better option, obviously, given that you're putting in also that much 10 lakh amount at the start itself. So, I'm going to wind it out, Kirtan. Just tell me if I'm going wrong anywhere. But SIF is mainly a fund which is a mix between traditional funds, where you get an option for 25% derivatives as well, where the fund manager can do, and that is what the difference comes in between normal mutual funds. And 10 lakh is the minimum amount. Then you can layer it up with an SIP, SWP, what comes in into later points, and mainly it's for retails, right? Non-retailers, HNIs.
Absolutely. There are two more points that probably I am assuming that the audience will find it useful. Redemption on the traditional side of the MF can typically happen regularly like it does every day. But like I highlighted on the SIF side, it is not necessary that redemptions may happen daily. It may be weekly or fortnightly. One very interesting point also to highlight here is there can be a notice period for redemption in SIF. So you may redeem it as of today and the NAV may be today, but you may receive your money, let's say, over 15 days of notice period. And also the portfolio disclosure on the SIF side typically happens or will happen once in 2 months, unlike in equity MS where it happens once in a month kind.
Okay, Kirtan, thank you so much for explaining us SIF and details and what an investor should look out for, who it's suitable for as well. On that note, viewers, we're actually going to slip into a very short break. We're going to continue our discussion with Kirtan, but we have more topics to discuss, so we'll be talking about all of that on ELSS schemes after this break. Welcome back. Thanks for staying tuned into Mutual Fund Corner on CNBC TV18. Now let's move on and talk about equity-linked savings schemes. What are they? Do they provide high returns? Who has, is it just a tax benefit kind of a move that you should be making by investing in these funds? Lot more on that. How are the historic returns, the pros and cons of this? We're going to continue this discussion with Kirtan Shah of Credence Wealth, who's here with us. Kirtan, ELSS, just for our viewers who may not know, what are ELSS funds? And is it only a good option for tax benefits or even otherwise?
So Vinnii, ELSS are typically equity funds. By definition, you need a minimum of 80% in equity. But look at it as a pure equity fund where 95% of the money generally will be invested in equity with 3 to 5% in cash for redemptions in general at an industry level. These are very similar to flexi-cap funds because in an ELSS fund, you don't typically have any market cap benchmarking, right? So you are free as a fund manager in the ELSS category to invest across large, mid, small, depending on where you think there is more opportunity available. Like you rightly said, that when you invest in these funds, you get up to 150,000 of advantage under ATC if you are in the old tax regime. But what investors also have to understand is that there is a 3-year lock-in in this. Now, of course, the tax advantage is a big reason why a lot of people invest in ELSS. But I would rather probably go a step forward and say that the 3-year lock-in actually makes a lot of difference in terms of the fund performance and the investor behavior. Because as soon as this is a fund with a 3-year lock-in and you can't redeem before 3 years, the investor experience automatically becomes much better. So if you really have to look at it from a flexi cap versus an ELSS standpoint, not only on the basis of return, but risk-adjusted basis also, these schemes have done decently better over flexi cap. So it's not just the tax advantage. I would rather believe that these funds in itself, without the tax advantage, have a lot of merit, and the discipline with a 3-year lock-in actually is the reason why the investor experience is much better in these categories.
Okay, it does make sense on that front. But, what are the things that one should consider as an investor while investing in an ELSS funds? You said there is a lock-in period also that comes in. What are the other factors that one should keep an eye out on?
Vinnii, actually, honestly, I don't really believe that ELSS as a fund is any different from any other fund that you typically want to onboard to make a part of your portfolio. So I think the most important thing is for you to be able to figure out what do you want to keep the portfolio construct as, right? Like say, for example, I sincerely believe that if there is an aggressive investor with 8-10 years of investment horizon, the best way to move forward is an equal weight portfolio across large, mid, small. Right now, if you look at the ELSS history, typically you will see that ELSS are typically funds on an average on a category basis, slightly more tilted towards large cap. So if I have to build a portfolio for myself, I will use ELSS in the large cap category and then do mid cap and small cap separately. So the first thing is don't look at ELSS as any separate from fund from any other category that you are typically looking at. It is as good as a flexi cap in that context. But if you want to deep dive and understand how to pick from the multiple ELSS fund, I think you can look at the rolling returns of the funds to try and understand the consistency of the fund. You can look at the information ratio, which will soon be issued on the fact sheet to understand the risk-adjusted performance of the fund. And if you can compare it with the category average and the index, I think you will be able to pick a decent fund.
Okay. And Kirtan, I just want to understand a couple of points. One is in terms of overall, when you're looking at it for, is there a specific way to invest in ELSS fund or similar to mutual funds? And ELSS versus PPF versus NSC and other tax saving instruments, is there a major difference between all of that?
I think, like I said, while you are investing in your ELSS, there is absolutely no difference between any other fund category versus an ELSS. You exactly invest the same way that you've been investing in any other categories in the mutual fund. It is just that probably there is a lock-in here that you need to be aware of, which most of these other categories don't have. While we talk about from a tax saving perspective of ELSS versus any of these other products like a PPF, I think what the investor community needs to understand is that you can't really compare an ELSS and a PPF because the asset class is completely different. ELSS is an equity fund, PPF is a fixed income fund, right? But let's say, keeping that aside, what are the different contours that you can typically look at? So the advantage that ELSS has is it has a 3-year lock-in versus, let's say, a PPF, which has a 15-year typical lock-in. And because it's an equity scheme, you, along with volatility, definitely are expecting slightly better returns than what a PPF will give you. And because interest rates will keep falling in a growing economy like India, over a period of time, PPF rates may go down. But very honestly, ELSS versus all of these other categories are not really an apple to apple, because like I said, ELSS is equity and everything else mostly in this space is fixed income. So in that sense, we may not be able to compare them, but definitely ELSS has a very short lock-in period. And because it is equity, the expected returns are definitely probably better than most of these other.
Absolutely, Kirtan, does make sense. And, who should invest in ELSS? You said, it's a normal fund as well. They give good returns as well. You spoke that in your first answer. You highlighted, in terms of an average return after the lock-in period as well. So, who should look at investing in it? And what portion of your, mutual fund portfolio that you have could be ELSS funds?
So, I think I can just think of 2-3 set of investors who probably may fit exactly well in the ELSS category. First is, of course, people who've opted for the older tax regime. They need to make sure that 1.5 lakhs on the ATC side of deduction is taken care of. That category is definitely the lowest hanging fruit to invest in an ELSS. Second, I would rather believe that, investors who probably want to do flexi cap, large cap kind of investing, but they are not able to figure out the right kind of fund in that category, are also the kind of people who can look at ELSS, because in my opinion, ELSS ends up doing the same job that probably a flexi cap or a large cap to a larger extent will end up doing. Right. And this is slightly contra as an opinion, the third one, but you will come across a lot of investors who are not very, very disciplined inherently as cells in nature. I think the 3-year lock-in will bring in that discipline. So if you think you're not very disciplined, look at this investment and it'll get you locked in for 3 years.
Okay, and Kirtan, right now, what are the options that are available for an ELSS fund that one could go for? Does each of them have a different return type of, performance-wise?
See, actually, historical returns may not be the right way of really looking at it because all of us know what happened in the past may not repeat in the future. But if you ask us as an institution, we typically prefer doing ELSS in two funds. First is the PPFAS ELSS tax saver, and another is SBI long term equity. I think these are two interesting funds from a track record and consistency and objectivity standpoint. And I think if there is somebody who's looking to do investments in ELSS at this point in time, probably can split the amount of money that they want to do in ELSS in both of these funds equally.
Okay, Kirtan, thank you so much for that. And thank you so much for joining with us on the show today. It's always a pleasure having you and chatting with you on CNBC TV18. But with that, viewers, we are absolutely out of time on this edition of Mutual Fund Corner. Thank you so much for tuning in. Closing bell up next to take you to the last hour of trade.